rates. I'll let the wall do all the talking, and looks like we are in for a good day of trade. It's a function of how the Nifty, of course, will open, but 100 points higher for the Nifty, 0.5% higher for the Sensex, 0.25% higher, almost a 1% higher for the small cap index. The breadth again phenomenal. The breadth has really been the high feature for this market, both in terms of the reversal and both in terms of the comeback. So it's a good market. It's a decent market. Let's look at the market in terms of the newsmakers. You had Tata Motors, big one. Zomato numbers later today. You've got numbers which will also come out from Titan later in the day. So ahead of numbers, Zomato is trending up. Tata Motors is reacting to the numbers. Titan ahead of numbers is looking quite warm. No big large numbers from the large cap basket, but you got to mention names like, let's say, Kirloskar Oils, where the pre-opening rates were not in sync with what they've actually delivered, and 7.5% lower for that one. Banks, are they getting ready for the leadership change now? Because they've underperformed, and banks really could be the way out. So there is a bit of a compulsive short covering which is at play. A week ago we were all nervous about bond yields, high crude prices, but look at the reversal. 4.99, almost 5 has become 4.6, and 96 on Brent has become 86. So this is a market where the surprise and the delight both has come in, I think, quite convincingly.
Quite convincing, yes, and there's convincing moves on a lot of these mid-caps which are reacting to earnings as well, right from a JK Lakshmi Cement to a Concord. They are reacting positively. You also have Ratnamani Metals doing with a gain of almost 3%. Tata Motors as well as Tata Motors DVR, Gujarat Gas, these are some of the other result reactions we are watching out for. 361, as far as Clean Science, these are the other two stocks which are in focus. And of course, there is M&M Financials as well, because it got that monthly data. It's pretty much flat on a quarter-on-quarter basis. Let's see if we are seeing any big reaction on that one. Surya Roshni is another result reaction with a cut of almost 4%, but it continues to trend higher. Most of the sectors are actually opening up with a bit of a green tinge. And then autos, of course, is leading from the front on account of that big gain that we have seen on Tata Motors. Let's check in for the first trades with our technical experts as well. Nooresh, what's the first trade you're punching in?
So that's a buy on Maruti. Looks interesting for a medium-term bet as well as a short-term bet at current levels. A big breakout about 10,000 done, so a buy at current levels as well as on dips.
Okay. All right, so are we getting ready for that year-end rally? Some like to call it Santa rally. Some like to call it the year-end rally. But at ET now, well, we would call that as the Happy Diwali rally. Yeah. Are we getting ready for Happy Diwali rally, which may start in Diwali and could extend to Christmas? Atul Suri joins us, and let's take that conversation forward. Good morning. Thank you for joining us.
Good morning. Nice
exactly to be here. A week ago, we said TGIF. Thank God it's Friday, because global markets were messy. Today we are saying why it's Friday, because global markets are looking solid and they're looking decent.
Yeah, I know.
Do you think that storm or the mid-air turbulence is over for us, and are we getting ready for a, in your terms, Santa rally?
Well, I think it's been very positive. See, Nikunj, one must consider that a month ago, almost a month ago, 6th of October, we had this whole Hamas-Israel issue that cropped up. And things went, we do not know the collateral damage, how these things spread. And in the hotness of the moment, a lot can happen. And that's represented by crude. Crude was around $82, $83, Brent. It went to 95. It was almost a 15% up move in crude, which is nothing but a reflection of how bad it could get. But now crude is back to 86. So if you look at it numerically, I think this gives us a sense that actually the world has dodged a bit of a bullet. Yeah. Because this thing could be big. Because, Israel is a bit of a quasi-US representative. So from that point of view, I think that's a very big digestion. Now, what has happened is that you'll find global markets have corrected 10, 11, 12%.
Okay.
Plus, you've had the Fed issue, which we'll talk about later. But I think we've digested a very big bad news. And I think that the markets are recovering, which is giving me confidence that in the overall scenario, we are in good. That is a typical reflection of a good, strong global market. That's such big bad news. It's a war. It's a war that's happening out there. And that is getting absorbed. And today, even if you look at something like the US, which corrected about 11%, SPX is about 7% from lifetime highs. And if the momentum continues, I don't see why we shouldn't get to higher levels.
So we've dodged a bullet, but does that mean that we are ready to run, or we still will be walking?
I think that now the attention, once this thing kind of settles, which I think it has, it will move back to the Fed. Now, if you look at the Fed's action in the last few days, the issue being inflation. The issue is inflation. If inflation remains cool and whatever, the variables that get into it, you will find that happening in bond yields. So just as we spoke about Brent crude, I think we now need to go back to bond yields. What you're seeing in the last 2 days or 3 days is nothing but a bond yield that went to almost tipped 5, right? And now we are back to 4.66 or thereabouts. I think we'll get to around 4.3. Which I think is great, because it's not that you're expecting it to fall off massively, but I think that the further we are away from 5, it is really good. And I think it's all about narrative, etc. But I do think that markets are oversold. They are due for a bounce. The quantum of bounce is really going to be based on news. And news is kind of ever flowing, especially as far as the Fed and inflation, etc. go. So I would like to point out one thing. One big takeaway for me in this whole correction is that again India has fallen less than global markets. The SPX fell 11%, we fell 7%.
It's a bull market correction, very savage, very sharp. Before you realize correction, it started, it actually gets over.
Absolutely. So the fact is that we have fallen less, and let me surprise you that what was thought to be an absolute bubble in Indian stock markets was small caps. Small caps have fallen less than Nifty.
Yeah, in fact, from Thursday's lows, Nikunj, the small cap index has rebounded 6.5%.
It fell 5, it is up 6.5, which means the net neutral impact is actually 1%.
Absolutely.
So Atul, for next 3 months, what kind of market we are in? Are we in a trending market, or we are in this market where you will crawl? It would be 2 steps forward, 1 step back. So the trend would be higher, but it's going to be a crawl, not a frog, not a giant leap forward.
I feel that it will be calibrated. As I said, it's not going to be runaway. I think like the next area is 19,850, then we've got 20,200. These levels are there. But sooner or later, Nikunj, I feel they'll be taken out, because as we are positioned, we've had a correction. It's great. It's always good to have a correction, because, things were getting too euphoric and a lot of stuff was moving. That's all corrected. But as I said, the quality of correction is very important. And, as I say, I love to do my research in corrections, because stocks that fall less in falling markets are leaders of the bull market. Markets that fall less, and as I said, India was a leader, and I think it's showing the characteristics of leadership. And where leadership was visible in India also continue to show. If the Nifty would fall 7% and everyone were unanimous that small cap is a bubble, that its excesses have happened, small cap should have at least fallen 10 to 15%. Yeah. It should have
fell about 3% only, right?
It fell about 5%. And I think we are just maybe 1 or 2%, depending on give or take where we are today. So the fact is that, and I have a thesis for that. I mean, we did some work. We realized that, hey, what is it? Of course, the important thing is the FIs are selling, which tends to be in large cap, and domestics tend to buy. So that's, of course, that apart. But we feel that the sectors that are trending, or sectors where the themes are, they hardly have a representation in the large cap index. If it's cap goods, engineering, infra, industrials, barring an L&T, which is a large cap stock, if you need to get into the sectors, you have to buy a small or mid cap. True. So if money flows into these sectors, as I said, we are trend investors, and we see that the trends are in these sectors. Now, if I have to buy something in those trending sectors, I have to go to a small and mid cap space. And that the pressure that is there, the trends which are less relevant are going to be the private banks and IT. And if you look at that, they're all the biggest caps in the market. So it's actually the sectorial shifts that are happening in the market which is really causing for this kind of behavior.
So net what you're saying is that even at index level, if we don't run away to that 21,000 mark, it's the mid cap and small cap and these specific stocks which are likely to outperform. But talking about the trends, the biggest trend that we have seen this year is the real estate sector.
Yeah.
That's of course made a bit of a comeback. But given the fact, Atul, cycles are getting shorter, whether it's a bull cycle, whether it's a bear cycle.
Absolutely.
What about this real estate cycle? Because we've already seen this cycle turning for the last 2 years now.
See, again, the interesting part is in this fall, you rightly pointed out that the only sector that made 52-week highs is reality, right? So that is definitely one big positive. But the question is that, as to how big we make the frame. Let's go back 10 years and let's see how real estate has performed. So you'll find that actually the dog sector for the last decade, There were two dogs, I tell you. One was PSU banks.
Yeah.
They were the best performing last year and they're the best performing this year. And real estate is the last one, I think, left still. But you will realize that if you extend your time frame, you'll realize that I'm not talking about 1 week, 1 month.
Yeah, sure.
But the fact is that when you have such a big revival in the market, when sectors after underperforming for a decade move, the rallies will not end in a few weeks or few months. They tend to be very elongated. And case in point is PSU banks. I mean, the trade of the last decade was long HDFC Bank and short any PSU bank. And if you see the trade of the last 2 years was actually the reversal. And we can talk about it today. But if I told you that 2 years ago, you say, listen, boss, what are you smoking up? Because it was a decadal move, you know. So it takes time. It takes time to adjust.
So what are you smoking up?
I'm a black coffee person, man. I love strong coffees.
But Atul, coming back to the PSU bank trade, there was a kind of crop of traders, investors who got in early, played the absolute low-hanging fruit, and then SBI, BOBs of the world went through a sideways kind of a...
Sure.
Is it providing opportunity to get in once again? Because it has not moved in the last 3-4 months at least, SBI, BOBs, but the numbers are supportive. Ownership has reduced a lot.
Sure.
You think it's giving time to get in once again?
I think so. I feel that what has happened is that they did run up, they surprised. They have corrected, every sector stocks have to correct. But as you see, I mean, I'm already seeing that right now, that in the last few days, some very good early breakouts are happening. So which gives me a sense that the next round also, these will participate and they have not topped out.
So Atul, actually I wanted to come back to the point. You talked about the dogs of the last decade. Which are the dogs you're identifying right now, which we'll talk about 2 years from here on? And what will make you comfortable on private banks? At what level or at what monitorable you will say that private banks are now perhaps looking attractive?
So my style of investing is I buy strength, I sell weakness. So at the end of the day, I do not know which sector when, okay? I'll wait for it to move. But my important thing is that what I look for, because at the end of the day, I'm a portfolio manager. I have 20 stocks, I have 20 bullets. So I really do not have the luxury of holding stocks for 2 to 3 years and waiting for them to bottom out. So I like to buy strength. So sectors that where we are seeing strength, I mean, we are extremely overweight electrical equipments, capital goods, infra. This continues to be our favorite. But where we are seeing interesting stuff happening is real estate. We are not overweight, we are underweight large private sector banks, but we are overweight NBFCs. We don't have any large cap IT, but we have some mid cap IT.
You don't own HDFC Bank?
I don't.
Very few fund managers don't own HDFC Bank.
I haven't owned it for the last 3 years. I think after the COVID fall, I haven't revisited.
So are they in this long winter, Atul, private banks?
One doesn't know, Nikunj. See, that is what time will teach you or history will teach you. We did some work, Nikunj. When I came in the market 1992, Harshad Mehta bull market, the Sensex had the top 30 stocks, right? As of today, only 5 stocks are still in the Sensex.
Actually less, I think.
No, I think
Tata Steel would be there.
The Reliances are there.
Reliance is there. Yeah, from the original, I think only 2 are left.
No, 5.
Okay.
From 1992, we've done work.
Okay.
We've done work. From 1992, Sensex, only 5 remained. And they were the best of companies. In fact, you'll be surprised that only 8 stocks have actually beaten the benchmark over 30 years.
Yeah, I mean, look at GE. I mean, you would never say that GE could actually be on a verge of collapse. And look at GE. So every company has a shelf life. Every
Premier Automobile,
of course.
Hindustan Motors, they were part of the Sensex. In fact, these companies used to have waiting to get a car. You had to wait for months. And if I ever told you that, hey, these companies would not exist.
So Atul, money is not made by looking at history. Money is made by looking at future. So
Absolutely.
what could be part of the Sensex 3 years from now? That's a better question, right?
I think that's a very relevant question. And as I said, that what is going to really change is that the last decade was dominated by 2 sectors, IT and private sector banks. Okay. I have a feeling that a lot of sectors have been ignored. Like we spoke about real estate, we spoke about cap goods and infra. I feel that these will actually re-emerge and you will see a higher weightage or a lot of stocks would actually enter from this phase. So I do think that from what I read in the markets, I'm a student of the markets, that we are setting up for an industrial. See, that has eluded us the last decade. That is why these few narrow kind of defensive plays worked out. But the way the market is positioned, the way stocks are moving, the way the numbers are coming out, I think we are set for an industrial revival. And as I keep telling people, and I mean, it may sound a bit boisterous, But I get a deja vu feeling of the 2003 to 2008 bull market because the sectors and themes that are moving are very similar to what had happened then. Of course, we were in denial for a long period of time. It's only after 2008 that we realized, oh my God, it was such a big bull market. But I do get a sense that once an industrial revival happens, that's the potential and the kind of bull market India can see.
You know, I had the same chat with Manish Dangi yesterday on the similarity which everybody is talking about. And he gave a great counterpoint. I mean, something when you chat with friends, you realize that what the great counterpoint is. His point is that, guys, I know everybody is talking about 2003 to 2008 kind of a market coming back, but look at the index. And let's look at the 2-year index return. The index has not given great returns. So if we are in for that kind of an economy and if we are in that kind of a market, in 2003 to 2008 bull market, the index actually went from 5,000, actually 4,000 to 21,000. There is no evidence of that happening so far.
That is the perfect setup. That is actually the perfect setup. If I was talking to you after a 70% up move in the index, tell me what was my risk reward ratio.
So are you saying that we are in for that kind of a gain on the Nifty?
Yeah, I mean, I don't think in the 2003 to 2008 bull market, we are in at 2007. I think we are more towards 2003-4.
Wow, that's a big statement.
So what I'm trying to tell you is that always the returns that will come will be lumpy. And there is an alternation. If I was sitting on 70% return, my risk reward ratio would not have been in favor. The interesting part is that actually in the last 2 years, for whatever we are saying, the indexes have not done much. We talk about real estate sector. What have these stocks done in the last 5-10 years? I mean, they have destroyed wealth. So the fact is that wealth was created in a few niche pockets in the last decade, so-called the 50 quality stocks or 60 quality stocks. The market is getting broad-based, and that is to the point we spoke about, the small cap index. If the market, if the Nifty fell 7%, the small cap index should have at least fallen 10%, if not more than 15%. And if there's unanimity that it's a bubble. So the fact is that the beauty is that we are coming off, I think, muted performances. And that's, if you have an industrial revival, the quality of rally and longevity of those rallies are always special.
Atul, I want to talk to you about this industrial point. If you could just pull up the capital goods index on a longer term frame, you would see that it started moving, made an all-time high, multi-year high, decade high, right? And then went to a sideways move because the large cap components, Siemens, ABBs of the world, came back, retraced. Perhaps a little more correction actually happened in the mid-tier engineering companies, mid to large. Do you see opportunity in mid to large ones or the top end of the capital?
No, I think there's a lot of opportunity there. I agree with you that, you know, some of the number of large caps in these spaces are so few.
Yeah,
that is why, and that is why they have become also, they have attracted those kind of valuations. But when you look at the mid and small cap space, you will find that the number of stocks are plenty. They have been underowned and ignored. And the interesting part is that these are the survivors. After going through the difficult time they have had, companies and businesses that have survived in this space are definitely the guys who are able to withstand difficult times. And I do think that they are going to be rewarded. And that is why you're seeing this kind of catch-up trade happening here.
So you've not held HDFC Bank for last 3 years, but which is one stock you will not sell for next 3 years?
I don't know.
As of today, if you have to take
Nikunj,
a view.
in my style of investing, as I said, I am a slave of strength.
Okay.
I realize that over the last 32 years, that ultimately the big wealth has been created in few pockets. And the quality that all these stocks showed was they continue to show strength. So I, for one,
Give me an example where strength has surprised you. Just we're discussing. It's not a recommendation. We're discussing 1 or 2 names to just establish the point you're flagging off.
For example, let's say electrical equipments, right? I mean, I won't take a name because I own the stock, but you'll realize it's a mid-cap space. But you realize that, hey, you know what of these companies which were unglamorous, boring, they went up. People say now they're at 40 PE, 50 PE, they have become very expensive. But these companies are delivering 30, 40, 50% returns. And what looks expensive one quarter suddenly looks cheap the next quarter. And as earnings keep coming, if you have an industrial revival, these companies will continue to surprise. And what people are scared to buy at 30 PE, 40 PE, because historically these have been 10 and 15 PEs. But the fact is, if the numbers continue to come, if they continue to deliver, that is really how bull markets are made. All great stocks you'll find that they have been expensive. Rarely have all the wealth creators been cheap. They have rarely been cheap. The fact is that these companies tend to beat. And when they beat, what looks expensive suddenly looks cheap. And that is what propels them from quarter to quarter, which becomes year on year. And that's how I think wealth has been created. So I'm one of those guys who's looking for strength. I'm looking for those companies that beat, and that beat consistently, because ultimately that's the characteristic of any wealth creator that you see in Indian stock markets.
Are you seeing any strength in the pharma sector right now?
I think there are very interesting places there. Again, this is a sector which probably from 2015 or so hasn't done much. All these big names, they have, I think once you had started having those US FDA problems, I think 2015, 16 or thereabouts, they have not done much. So I think they're very quietly moving. But what I find more interesting is the healthcare space. And there I like hospital stocks. We do have a fair allocation towards hospital stocks. They are not your typical pharma stocks, but I think that is another very interesting and secular play, under the radar, under-owned, but I do think that is actually trending out very well.
Would you like to revisit your Nifty target of 21,500?
Not really, Nikunj, not really.
You want to extend it now because it's
in
not
fact,
very far.
that is when I would tend to be cautious when I get so myself, this thing, I realize, oh my God. It's typically that at 17,000 to say 21 is very difficult. So there's disbelief, then there's acceptance, and then you laugh about it. So when I start laughing at my target, I actually should be careful about it.
So 21,500, then when it reaches there, you'll take a fresh guard.
Yeah, we look at that. We look at new realities the world is see, and ultimately that number is not about that number. It was the direction.
No, just
21 ka 22 ho gaya ya 21 300 bhi ho gaya. That's no big deal. That number is just as a signpost. It's telling you where the direction is, right? You have a North Star when you're a sailor. I mean, you're never going to reach the North Star, but the fact is, you know in which direction you have to go. And as an investor, ultimately, the question is that when there's a correction, am I going to buy? Am I going to buy on dips, or am I going to say, oh, it's too much, let me move into cash?
Pollution North Star दिखता कहाँ है आजकल?
Holidays are on your mind, not sailing. All these
You don't see the North Star in so much. Bombay is getting polluted now.
Yeah, I know. Man.
So for those, now tell us a new strategy. North Star तो नहीं दिख रहा है.
North Star नहीं दिख रहा है.
Okay, before we wrap, let's identify it, and I'll phrase my question carefully here. The best trade according to you for next 3 to 6 months, 1 to 3 years, and 3 year plus.
I think it's going to be the story that is linked to industrial revival. It is
so
not the stocks that dominated the last.
This is 3 to 6 months.
3 to 6 months, 6 months to 1 year, 1 year to 3 years.
That's the standard. Okay.
I still stand overweight in the space, and as I told you that my style of investing is that I look for strength. The market is showing me strength. The numbers that are coming in this space, yes, things will change. Nothing is perennial in the market, and when they change, we are fast enough to change. We are flexible enough to change. We have no ego, no storytelling,
no, but
nothing of that sort.
But
genuinely, as a place, as a sector, as a theme, I really like stocks that have not moved for the last decade.
But any asset class allocation 3 to 6, 1 to 3, 5 plus?
I mean, sectorally, I think, as I've said, I like capital goods, I like infra, I like engineering, electrical equipment.
No, asset class, I mean, outside equities.
I'm such a equities guy. All my life, that's the only thing I've done. I'm unemployable and useless in any other trade. Yeah.
On Diwali, it is the joy of giving. So if somebody says, Atul Suri, happy Diwali, please oblige us with a tip.
Diwali abhi aaya nahi hai.
Aane wala hai. You'll be traveling before that.
This is like stress. This is stress. Okay. I haven't actually thought about it.
Okay, fair enough. But what I wanted to ask you, and I'm intrigued to listen to your views on this. You talk about trends, you're talking about capex, which is one of your themes. What about this premiumization and affluent India that we are seeing? Are you not interested in that theme? Are you okay to let go of that, or what's your view?
It's not that. It's ultimately, there are some themes that we have. We have some FMCG plays which are in the food space. It's not the soap and shampoo
the packaged foods and
it's something related to that, etc. So we like that kind of space. We have some plays in that area, and I think that those are also interesting plays. So you can't really look at premiumization. I think the numbers will come, and then you'll realize that okay, there is something happening out there.
You use it on a consumer basis, but not in the market. The affluent consumer angle. But in NBFCs, which side are you liking it? Is it microfinance? Is it housing finance? Because
we like some of the AMC related
wealth management
related capital marketplace. We think that is the biggest tsunami that's happening, and we are very, very fortunate to be at a time when and I think you guys also, thanks to you guys, and you guys also are beneficiaries and the creators of that kind of awareness that investors are noticing. And that is really resulting in an amazing boom in the whole retail.
Would you buy a
investor
brokerage,
space.
AMC, or a wealth management company?
I think I would look at all three or what are overlapping on all
Atul
three.
Suri is
also.
saying, don't ask me so many questions, just join my PMS. You get all the answers right now there. Right, simple. Atul.
Yeah, it's too much regulatory stuff. Can't talk about stocks, sorry about that. But we used to do that. I remember when we would, many years ago, openly talk, but now you have to be very
Now you have to
careful.
really...
You have to be
Measure your
between
words.
the lines. Reality. It's a reality.
But not start with pollution, man. Trust me. That's the unfortunate reality, whether we like it or not.
Let's go to Ladakh.
So nice to have you.
Thanks,
And
man. Thanks a
you
lot.
for
Thanks,
that.
guys. Happy Diwali to all of you.
Okay, so that's the latest coming in from Atul Suri, not liking private banks or large cap equities right now, large cap IT that is, but what he is interested in the capex theme and the real estate sector and NBFCs of course. So let's welcome on board one such NBFC. We have the management of Chola Financials joining us on the show very shortly. We have Arun Selvan, the president and CFO of Cholamandam Investment and Finance Company with us on the show. Hi, thank you so much for making time and speaking with us. I just wanted to begin by discussing your disbursements and AUM because that has continued to show a solid growth of 40% thereabouts. What's the view going forward? Because you had started the year with a guidance of around 22 to 25% growth. Are you really looking at that?
See, to answer your first question, the growth for the full year, we still would like to keep it around the 25%, around the 25% mark because Q3, Q4 of last year was very large quarters. The Q1, Q2 were small quarters. If you compare the numbers last year, you'll see that. So you will see this growth sort of from as a percentage in terms petering out in Q3, Q4. And overall, we still would like to keep the targets around the 25% mark. Maybe between 25 to 30, we should clock depending on how the festival demand, sort of picks up. With regard to segments, actually we are firing on all cylinders across all the segments. So every segment has shown a reasonably good growth. Vehicle finance at a 30% plus growth. The LAP at a good growth. Home loan at a good growth, and the new businesses are also picking up. So we are in a stretch of time where every business segment which we have been pursuing is showing good growth. So that's what you will see as we move into the next 2 quarters.
So, we are at that time of the year in our economy, festive season is underway, demand usually improves a lot. So what's your outlook on credit demand, especially in the new and used vehicle segment? And of course, because there was some concerns in the used vehicle segment of pressure earlier. Is that likely to change?
No, we actually have been growing the used segment well, and we see there is still some, demand as well as supply available because the demand is coming because there is the BS4 vehicles are coming into the market still, and we are able to sell them. And there are price differential between a new BS6 versus an old BS4 is still, attractive for the customers to go in for BS4 vehicles, especially vehicles of lower vintage, let's say in the 4 to 6 years range. So these vehicles are being preferred, and we are seeing good traction there. So I think it will continue over the 2 cycles, next 2 quarters, And we are seeing good demand even in the other segments, which is the lights and the tractors as well as in the 2-wheelers and cars. We are not focusing, there is reasonable growth on heavies. We are not focusing on heavies because, right now the yields are fine and cost of funds being high. We don't want to take too much exposure on heavies. But for it, every other segment we are focusing on.
Let's talk about your home loan end of the business. That's grown very strongly this time, closer to 70% on a yearly growth mark. Talk to us about the expectations in terms of disbursements over there, especially in the second half. How's the competitive intensity in that segment? Because other players are also doing pretty strongly.
See, we are growing the home loan segment in different geographies as compared to what we have been doing a few years back. We were earlier focusing only in the southern part of the country, while now we are moving into the north, west, and south regions also. So there is a good demand, and our presence there already by way of vehicle finance branch has given us the ability to penetrate these markets without having to suffer any credit losses. So our knowledge of the market has helped us to get into these markets quite quickly. If you see, most of the other housing loan companies are more geographic specific, and while they try to attempt other regions, they have some difficulty in establishing because they are new to this geography, and the home loan market is dependent on understanding the local geography and local credit culture and the local industries in which the self-employed non-professional is engaged in. So we have that knowledge, and that helps us to quickly penetrate without taking any undue losses.
Arul, your NIMs, the margins have expanded this time round, mainly on the back of repricing of loans and partly by a marginal decline in your cost of funds. What's the outlook from here on, especially on the cost of fund side? Do you see scope for improvement further from these levels?
Yeah, NIM will move up as we reprice the vehicle finance book, we have discussed earlier. That when we did have a price increase on the cost of fund side, we could not do repricing of the vehicle finance book because it was a fixed rate book. However, progressively the fresh disbursements are coming in at higher rates, which is enabling us to sort of improve the NIM on the vehicle finance book, which is where you are seeing the traction on the yield improvement as well as the NIM improvement. We have been holding the cost of funds at same levels as Q1, and we see we can marginally reduce it in the next 2 quarters as we see. But there are a lot of improbabilities in the cost of fund side because rates are still not shown a clear direction towards a downward trend. It's been moving volatilely, but we expect that we should have some traction on the cost of funds.
Your new business have also started contributing meaningfully. What is the kind of growth you are targeting from these now?
See, our sort of expectation over the next 2 to 3 years would be that the new businesses would be in the range of around 20% of the overall AUM. This is what we are targeting. While vehicle finance, while it will keep growing at a reasonably good pace, will as a proportion of AUM will come down progressively from the current 61% to around 50 to 52%. And the LAP and home loans will also take a higher share from where they are today. So thereby the mix will change, reducing large dependency on vehicle finance and progressively bringing up the rest of the businesses also to contribute to the overall growth as well as profitability in a meaningful way.
While overall asset quality is holding on quite well, GS3 in newer businesses deteriorated to 1.5% versus 1. Is that a cause of concern?
If you look at it from an industry perspective, we are still very much well within what industry experiences on such businesses. So we have also articulated that when we are initially starting, the stage 3 numbers or the delinquent numbers would look low. But they will stabilize at somewhere closer to the industry norm. But our endeavor would be to keep it below the industry level so that we have an advantage. And that's where we are directionally moving towards.
Let's talk about your capital adequacy then. Standing shade lower than 17% on September end versus a requirement of 15. So you've provided for a much higher capital. You already completed a QIP and a CCD issue as well, which has received good response. From here on, what would be the capital adequacy overall blended, the kind of runway of growth that you have right now?
The capital adequacy post the issue would be about 20%, both Tier 1 Tier 2 put together, and Tier 1 by itself would cross the 16% or 16.5% levels. So we are quite comfortable, and Tier 2 we have large scope to bring in additional other instruments like subordinated debt or perpetual debt. So we have a good headroom, and the CCDs and today's CCD, when I gave these numbers, the CCDs are taken as part of Tier 2, and when they convert, it will again push up the Tier 1. So we have a runway of around 5 to 6 years with these levels of infusion, including the conversion of CCDs.
Since we have with you just a clarification on the latest family settlement news, is there any impact on the business because of that?
No, it does not. So it is a direct deal from the promoters to the exiting party, and we don't have any direct connection to Chola or any of its subsidiaries or associates.
All right, Terrell, thank you very much for joining us on the show, and good luck for your coming quarters as well. That's Chola Investment, the roadmap and the results. We'll take a short break. On the other side, we'll talk to the Bernstein analyst on how the banking numbers are shaping up and what to expect from the sector on the other side.
The markets as to whether we are holding on to that level of 19,200 or not. Yes, seems like 19,240 has been held. There hasn't been a big move at the index level for now, but within the stocks, it's Concord, which is higher by around 5%. The margins did improve, and the profitability was better than expected, almost a 20% beat versus expectations. Torrent Power is the other one, which is higher by 5%. Suzlon Energy, Apollo Hospital on account of that Morgan Stanley initiation, and then Zomato ahead of its earnings is definitely perking up. On the losing side, however, Sirma SGS continues its slide from yesterday, and Kirloskar Oil as well as Sheila Foam are the result reactions we are watching out for. Pranav Gundalapalli from Bernstein joins us on the show to talk to us about the banking sector. Remember, this morning there was a big note that came in on Greed and Fear as well, talking about the banking sector and how perhaps the ownership, despite being quite high, there are various verticals of the market that might look at investing more into the private banking sector. Pranav, that's exactly the first question. The private banking space, especially the large cap banks, haven't done much at all in the last many months, despite the decent show as far as earnings is concerned. What explains that dichotomy as per you?
See, I think there are two things happening here, right? So I think one, you've had pretty much the rest of the sector outside the top four banks really seeing a big earnings improvement as the credit cost normalized, right? So you had the momentum of a big year-on-year growth in earnings numbers. So that led to their re-rating. So that is one thing which is happening. The second is also that over the last 12 to 18 months, you've had a bit of a convergence of the operating metrics as well. So if you look at in many quarters last year, some of the smaller public sector banks were reporting the same growth and ROE numbers as some of the large private sector banks. So I think these two would be the key reasons, I would say. And you are seeing signs of those again weaning away. Right? So I think you are seeing the operating performance diverging. Now you have growth which seems to be higher for the private sector banks. So I think some of that will drive interest back into the large private sector banks.
Do you think best of the earnings momentum is behind private banks, because NIMs now in a sense will peak out, competition will only intensify, fintechs are becoming more and more stable now as businesses, which will eat into their market share?
I think one thing which has happened structurally is that the Indian bank, especially the private sector banks, will have a more cyclical earnings profile going forward, right? So if you look at the last 15 years, the NIM have been flat irrespective of what happened on the benchmark rates. Now that has changed, right? So you will have that cyclicality. So yes, on a NIM front, we are past the peak for sure. But what the banks do have is they have other levers to pull. The OPEX, for instance, is the OPEX growth is at a much higher pace than what I would call the normal pace. All the banks have built up a decent amount of credit cost buffers. So they would start using that to make sure that the earnings trajectory is smoothened out to a certain extent.
Okay, what is the best way of looking banks? There are two type of banks. One retail dominated, second wholesale dominated. Where do you think in the near term there could be more bang for buck?
See, I think at the end of the day, it comes back to what is the ROA, or at least return on risk-weighted assets. So I don't think it's fair to call retail better than corporate. It's not always the case. The retail is generally more stable, which is why investors tend to like it, because it's granular, and therefore you will not have the same volatility that you have with large corporate lending. So that's the only reason. But from a returns perspective, I'm more bullish on the corporate segment coming back, because that is a segment which has not seen growth for almost 10 years. And now you are having all the right indicators suggesting that the demand for corporate credit is going to come back. And that could be the next big catalyst for the sector.
Okay, point taken. But we were also discussing this PSU banking space, right? Pranav, what's your view on that? Do you think the bulk of the rally is behind? And it's probably advisable for investors to probably trim their positions there, or it's just time to reach on and take money off from, let's say, just the large cap PSU names to maybe even the smaller ones?
See, I think the large part of the re-rating is done, right? So I think you had that re-rating rally from banks at 0.4, 0.5 times price to book to 1 times or 1.2 times. So I think that explained most of the performance in the last 1 to 2 years, and that is done, right? Now what we have is going to be more of the usual compounding, returns from compounding, which might hold on for a while. So yes, one could stay invested, but the expectation should be more nominal, right? So if they grow in line with their ROEs, which is not too bad right now, but that's all there's going to be. And that growth differential, I think, is also going to start to show up. So I think this quarter, you've started seeing the large, some of the public sector banks come out with deposit growth numbers that are, at best low double digits compared to high teens or almost 20% plus for a lot of the private sector banks. So that growth divergence will start to kick in. So that will ensure that there is no further widening of the valuation multiples. But no risks as such for the PSUs where you should expect a multiple derating at this stage.
I request you to stay with us. We'll come back after a very short break and also look at the other lending pieces beyond banks as well with you on the other side of the very short break.
It is the perfect bachelor pad.
तो कब लेना है?
Area of the market in the lending space or financials, I would say, which is exciting, is NBFCs. Not only the lenders, but a lot of asset market plays, a lot of card companies, financial intermediation. What's your pecking order in as far as attractiveness is concerned?
See, I think you are seeing a spurt of new lending models emerge. And I think there is a genuine reason why they are emerging, right? So the digital channels have lowered the cost, both from an acquisition perspective and also the cost involved in delivering a loan. So I do expect a few winners to emerge from this space. Now, we haven't, we like Paytm at this stage, given that they do have a clear right to win in certain segments, right? So the idea of providing credit on top of a payment platform is something that has worked well in many other markets. And Paytm seems to be ahead of many of its peers at this point in time. But looking generally, I think we are more bullish on the segments where the banks really don't want to play. So this is literally about expanding the pie rather than competing with the banks. So the cost of funds advantage of banks will mean that the role of the alternate lenders, if you want to call them that, would be limited to smaller ticket size niche segments. And we do see that to be a large opportunity.
Right, Pranav, thank you very much for joining us on the show today.
Thank you.
Let's move on and talk about earnings which are coming in. Kirloskar Oil Engines is in focus right now. The stock is taking a knock in trade. Numbers have come out. Numbers show margin improvement. But if you look at the 1 year chart, look at that. 280 rupees was the kind of levels when they had announced an analyst day, and there was a very big detailed presentation shared, and the stock has doubled within this year itself. Gauri Kirloskar, who's joining us right now, MD of Kirloskar Oil Engines, to share with us the roadmap from here on. Gauri, morning. Thank you very much for your time. There's a margin expansion as well, but the street appears to be slightly nervous on your numbers today, if today's reaction is concerned. But I'll take the clock back. You had indicated how the business will grow on a next 3 to 5 year basis in your February Analyst Day communication to the street, which happened itself after several years. Are you on track to that guidance, the direction which you had guided towards, if I were to look beyond the quarter to quarter kind of movement?
Sure. Thank you very much. And thank you also for having me on the show. So the strategy actually was announced last year in August. And what we had said at a broad level was 2x, 3y. So there were 3 pillars that we were focused on. This was doubling our revenue to 6,500 crores by FY26, as well as achieving a double-digit margin. The second pillar was enhancing customer satisfaction. And the third was becoming an employer of choice. So when I see where we are in that journey today, I'm pleased to report that we're well on track. If you look at this half year and the results that have come out, we have achieved a 19% year-on-year growth in the first half of FY24. And also, if you look at it from a base year of FY22, we are actually tracking at 25.5% CAGR. And the CAGR that we would have to achieve 2x, 3y is 26%. So we're very close to that. If you look at our margins, and I'll also speak a little bit about, perhaps why we're seeing a knock in the stock market, is because if you look at the half year, we have achieved double-digit margins. But if you look at the quarter performance, it's a transitory quarter because we've just been through an emission norms change. And we have seen a reduction in volume in Q2 as compared to Q1 because there was a significant pre-buy in Q1 that happened because of the CPCB4 norm change. And because of that volume reduction, we have the operating leverage not kicking in, and therefore a knock-on margins per se in Q2. At the half-year level, though, we're well on track, and I'm confident that we are building a strong base of sustainable profit. If you look at the second 2 pillars, enhancing customer satisfaction, we just actually launched some products last month. Of course, our whole range of CPCB4 gensets, but also a new range of what we call our Opti Prime series. And this has really been designed keeping the customer in mind because this product achieves fuel efficiency. It can save costs up to 20% for the customer, and it can also reduce emissions up to 50%. So without going into too much technical detail of what this product is, I would say that we're really as a company thinking about how we design products from the customer point of view. And the third one, which is becoming an employer of choice, we're investing in people and we're investing in developing the capability of people. And I think the metric that we track here really is employee retention rate. And I'm happy to say that since last year, we're seeing an improvement in retention of employees at Kirloskar Oil Engines.
Point taken, Gauri. You're talking about how this entire volume shift is transitory. But when do you expect the recovery? Are you expecting it in Q3 itself, or will it take some more time?
So if you remember what happened with CPCB4, just 2 weeks before the deadline, there was actually an extension of the CPCB2 emission change as well. So today we're in a pretty complex situation when it comes to supply chain and manufacturing, where we're actually running an unemissionized line, which is a CPCB1 emission norm. CPCB2 is continuing, and we have CPCB4. So in certain market centers, such as if you look at Delhi NCR, we have very strong CPCB4 demand coming from there. But apart from that, we really see the CPCB2 continuing as well. So if I speak about order book, and if you're talking about this transition, I'd say that the transition is going to extend out over this year until next July. But if we look at our order book, it's actually very strong in power gen for both CPCB2 as well as CPCB4. And we also have a strong order book from the industrial side because we're seeing that continued spend in terms of infrastructure, and we have quite strong orders from the railways, defense, etc.
You've clearly outlined the growth direction and the strategy you will actually deploy to achieve that growth. But we are also gathering that there's a lot of impetus being given on product development and extracting efficiencies on the shop floor. We gather you are spending a lot of time with your engineers at the shop floor yourself. What kind of margin levers are you pressing so that these better designed products would actually get a higher sense of profitability as well in this growth trajectory which you've taken up?
Sure. So, I think that generally when we look at margins in our business, and I've spoken about this during our strategy, is when we look at the high horsepower range, so building larger engines. And today I'm happy to say that, as an Indian company, we have developed most of our engines and gensets in-house through our 250 plus engineers that we have here. And we have the largest range. So we go from 1.1 liters to almost 50 plus liters in terms of our engine range, which is the largest in the industry. And it's all developed in-house. But if we look at where the margins profile kicks in, it's really on the high horsepower range. And we have started to move there. In fact, the product launch that I just mentioned, the Optim Prime range now actually allows us to go up to 3000 kVA. Our previous range was only up to 1500 kVA. So these are obviously highly technical products which command a better margin. That's number one. The second is exports and the continued focus on exports. Now, exports takes time, but we are investing into seeding these markets. The most recent development at Kirloskar Oil Engines is that we have appointed an exclusive GOEM in the Middle East. So a GOEM is a genset OEM. So that will help as well in building the export business. And the third is, of course, service or our aftermarket business. And as our products get more and more technical, service also then becomes more proprietary. So as we increase our service penetration, and that is what we're focused on, we will start to see the margins expand.
On that note, we'll let you go. Thank you so much for joining us and articulating your strategy. So candidly appreciate you making time. But time now to shift gears and talk about the technicals of the markets. We have Nooresh Murali back with us with his Chartbuster idea. Nooresh, which one is that?
So that's a chart for Maruti Limited. If you look at Maruti, the stock made top around 10,000 back in 2017-18, couple of times could not cross it. We saw a correction in 2019-20, again made a comeback closer to 9,500 to 10,000 mark in 2022. Then again a few months back, and now finally the stock after multiple attempts has crossed above the 10,000 mark. Did the initial move, almost did a retest also in the last few days. So out here now setting up for the next leg of the move, wherein it could go all the way towards the 12,000, 13,000 or even higher over the medium to long term, and accumulated 10,500 to 10,100, and a stop loss to be kept at 9,900.
What are the other stock ideas right now?
So first is the buy on RBL Bank, which has seen a strong reversal, a stop loss at 220, target price of 245. Second is the buy on Torrent Power, a new 52-week high out here, strong momentum, stop loss at 750, target 820.
Thanks for that, Nooresh. Take a short break, come back, and news and analysis will continue on the other side.